We are off to the races. So a good afternoon, everybody, and welcome to another installment of 10-minute lessons. My name is Alana Dunoff. For those who may not know me, and I've got Jim Myers with me as well, our partner in crime here. And for those who don't know me, my quick backstory, I've got about 30 years in facilities management. Mostly as a strategic planner and project manager. For the past 18 years, I've been an adjunct professor. I'm currently teaching at Temple University. And I'm also an instructor for both the IFMA FMP and the Pro FM credentials. And I've been teaching those for 10 or so years as well. So today's topic is 6 accounting fundamentals for FMs, really for anybody, but we're all FMs, so that's what we're gonna focus on. And accounting, I have to say, was never my strength. I took an accounting class in graduate school and it did not go very well. And when I started teaching the credential courses, and finance is such a big part of facilities, I was a little bit nervous about it because I really felt like I had to learn this all over again. And I think that I did, and I think I hopefully have learned it in a way that I can explain it to give a basic understanding of what it is and why it's important. So I've got 6 fundamentals to share with you. I hope I can do it, and I hope you learn a little bit along the way. So here we go. So first one is what accounting actually is. In the really sort of big view, accounting is a financial record keeping system. It is a way to track all of the financial transactions in an organization, money coming in and money going out, money in every different direction of an organization. And it's really about data. And I'm a data person, so I go, oh, wait a second, I get it now. Accounting is all about keeping data and keeping information, making sure it's accurate, reliable, and timely. It's just that that data happens to be financial in orientation. And I liken the accounting system to a CMMS system, where we're also collecting a lot of data and information, our work orders, our preventative maintenance, our corrective maintenance, and we're collecting all of that information so that we can report on it, we can learn from it and understand it. And that's exactly what an accounting system does for the finances of an organization. The second fundamental is that there are really 2 types of accounting. There is financial accounting. Financial accounting is governed by accounting standards. In the United States, it's called GAAP, and there's also an international accounting standard. And these are the standards that our accounting departments in our organizations have to follow and have to use in order to collect data in precisely the same way and report on that information, because the financial accounting creates the reports and information that goes to the external world. So it goes to Wall Street and creditors and Uncle Sam and shareholders. And this is the information they want to see consistently month after month, quarter after quarter, which basically says how we did as an organization. But there's also management accounting, and management accounting is taking that same information, the same data, and using it internally to help us manage our organization. This is how we look at dollars to say, hey, we can hire more people, or we have to freeze on hiring people, or we can buy more, or maybe we have to hold back or pull back on our budgets or cut down on our expenses. So management accounting is the process of looking at how we're going to take those dollars and use it to help us grow our business or manage our business on a daily basis. Both are really important. For the rest of this conversation, I'm going to focus a little bit more on the financial accounting. The third fundamental is that every accounting system has essentially 3 types of accounting records. And accounting records is just a fancy term for documents. So 3 accounting documents that are a part of every accounting system. The first one is called the chart of accounts. And essentially the chart of accounts is a coding system that tracks every piece of financial information, every piece of every transaction that happens in the organization gets a code. And if we go back to the CMMS example, as an example, every time a work order comes in, we also give it some kind of a coding system. We say, oh, that's a plumbing issue, or that's an electrical issue, or that's an HVAC issue. And we do that in order to help us sort the information. I'm going to come back to the chart of accounts in another minute, but I want to just get the basics out here. The second type of accounting record is what's called a journal. And they often say that the journal is the accounting book of original entry. So think of like Dear Diary. So Dear Diary, the first entry that you put in, and when we put information into the journal, it's in chronological order. So today is April 1st, and I bought something, and that's how I start to transact that information. The thing about the journal is that there are 4 pieces of information that gets entered in for every transaction. So the date, because it's done in chronological order, and then the explanation, whatever that transaction was. I bought something, I paid something, it's an asset, whatever it is. And then there's a credit and a debit associated with each one of those records. I'm also going to go back and share a little bit more on that in a minute, but I want to finish the accounting documents first. So the journal is the original entry. And then the third document is the ledger. So the ledger is the accounting book of final entry. So essentially what happens in the process is the transaction is entered into the journal. It then uses the chart of accounts to add its specific code for that particular entry. And then it is posted into the ledger. So it goes from the journal to the ledger by using the chart of accounts. And that's how all basic accounting systems work. Now, of course, there isn't the paper processes that were done a long time ago, and this is all very electronic, but it's still the process that happens in accounting systems. All right, so number 4, let's go back to this idea of the chart of accounts, because I think this is really paramount and essential to understanding how the data is categorized and organized for in the financial world. So the chart of accounts, again, is a coding system. And the graphic here is just an example of one chart of accounts. But what you can see is that it's broken into sort of categories or buckets. And under each category is other smaller groups that relate to that particular category. So the 5 basic categories that most organizations have in their chart of accounts are as follows. The first one is a category for their assets. And these are all the things that retain value for the organization. So it could be cash, it could be their inventory. The building that we manage is part of a huge asset of our organization. And accounts receivable is also an asset. And then there's the liabilities. Those are the debts. Those are things our organizations owe. If all of you work for a company and get a salary, you are liabilities to your organization because your companies owe you money on some regular basis. But a mortgage is also a liability, as is accounts payable and the bills that we get that we have to pay. Another category then is net assets. And net assets is what's left over from our assets and our liabilities. So it's what we have versus what we owe, and whatever is left is that equity or net asset. And there is a category associated with that as well. And then the last 2 categories that are typically in chart of accounts are revenue and expenses. So revenue is our income, the money that comes into our organization. This is how our companies make money, whether it's in exchange for goods or services, or revenue could also be investments that we might have in our financial portfolio as well. And then the last one is expenses, because we have to spend money in order to make money. The expenses are the things associated with making the widgets that we're selling or the services that we're providing. And so that's another category that we try to track information in. So that's the chart of accounts. Number 5, debit and credit. Here's what I want you to do first about debit and credit. I want you to forget everything you know and think you know about debit and credit. Because in the accounting world, debit and credit has nothing to do with the debit card or the credit card in your wallet. And I really wish my accounting teacher had told me that back in school, because maybe I would have understood it, because I have a different mindset of what these terms really mean. So way back when, way before computers and counting machines and so on, when an organization was trying to track their financial information, they would do so with pencil and paper. And when you're tracking that information, one of the things we know about accounting is how important accuracy is. So they developed a system called double or dual entry accounting, which essentially means that they're going to create a checks and balance for every entry, every transaction comes in. And that means they're going to assign what they call a debit and a credit to every entry. Because if you think about it, when you're creating and trying to be accurate in your information, that every entry has two entries, and that allows you at the bottom, at the end of those entries, to tally them up and realize if they are the same. Because back in the day when you only had a pencil, your 8 could be a 5 or it could be a 3, or you could transpose numbers. And since accuracy is so important, they created a system to do that checks and balance. And that's where the idea of the debit and credit came from. Because in accounting, the definitions for debit and credit are actually pretty simple. That debit is just amount due to be paid or already from an account. And credit refers to a positive cash entry and sort of the opposite of debit. And the thing that I really wish I understood was that I always assumed debit feels like you're losing something or credit feels like a positive. But in accounting, debit and credit does not automatically mean an increase or a decrease. It's just really about where the entries are recorded in the process, and they're recorded into those different buckets that we saw associated with the chart of accounts. Now, I know it actually goes in a little bit deeper, but to understand this at the most fundamental level, I think is a really good place to start. So then the last thing I want to share with you is about financial reporting, because we said this is an accounting system, collects data so we can make reports. And there are a number of reports that our organization puts out on a monthly and a quarterly and an annual basis to the outside world. Two of the most important reports that are done are one's called an income statement and one's called a balance sheet. So the income statement shows profitability, shows how we did it over a certain period of time, how much money or revenue we have had come in. And the balance sheet shows solvency. So there's two things I want to share with you here. First off, if an organization only shows you their income statement, that's not enough to know whether the organization is actually doing well and has a good financial health. And if they only print off a balance sheet, that doesn't show you enough either, because it only shows their solvency. They might have some assets, but they also might have a lot of debt, and we don't know anything about how much money they have earned. So organizations have to print out these and a couple other reports, and you have to look at them together, because the narrative together is what gives you the whole picture. And the thing that I want to sort of circle back here, it goes back to the idea of the chart of accounts. Because if you look at both of these reports, the income statement is all about revenue and expense, and the balance sheet is all about assets and liabilities. And if I showed the next page, it would say net assets too, because those are the things that organizations care about, and that's what we're reporting on. So it connects right back to the chart of accounts, which is how we code every piece of financial information that comes into the organization. And we code it that way because we have to present it back out to the rest of the world and how that information works. So the last thing is sort of the why. Like, why do we even care? Like, we're in facilities. Why do we care about accounting? And the truth is, it's because finance is the language of our organization. They care about money. Whether we like it or not, it's how things work. And we don't have to love accounting or love finance. We don't even have to like it. But we do spend a lot of money in our organizations, and we manage their buildings, which is, next to people, the biggest asset our organizations have. So at the very least, we should have a fundamental understanding of a little bit of accounting. And that is your maybe 11 or 12-minute lesson. I did it, yay. Did that work? Did you understand it? Did anybody learn anything there? I hope so. Okay, so we have two more 10-minute lessons left in our series. Jim is gonna hit process flowcharts next week. I can't wait to see what this one's all about.
That's so exciting.
So exciting.
We'll make it exciting.
So we have this one coming up. I also wanted to let you know we have a new website called learntobeanfmpro.com, and we are now putting all of our old 10-minute lessons on there, and there's more information. It's sort of growing, kind of soft launching it, but if you get a chance to take a look at it, I would love your feedback. And that's all I got. Jim, anything else you want to add?
I don't think so. I learned some things here today too, and appreciate what you said, Alana. Great job.
Excellent. Well, thanks everybody. Any comments? Happy to hear them. Otherwise, I'll take a thumbs up or something in the chat. All of those are good.
Alana, nice job.
Thank you very much. And how about that for April Fools? You know, it wasn't even an April Fool's Day joke. So thanks everybody.
Thank you.
Great rest of your day.
Take care. Bye.
Brian.
Hey, how are you?
I'm good. How are you?